Hello, everybody. We're back. Thank you for joining today. My name is Jeff Lusick. I'm the head of the retail sales team with Horizons ETFs. So welcome to today's webinar, which is an update and a Q&A session on the Canadian preferred shares and corporate bond markets. That's featuring Nicolas Normandeau, who's Vice President and Portfolio Manager on the Integrated Fixed Income team at Fiera Capital. So before we get started, I'd like to go over a few items so you know how to participate in our webinar. You're going to have a chance to submit text questions within the presentation by typing in your question into the questions pane of the control panel that you see on your webinar. You can send in your questions at any time. I'll do my best to collect these, maybe aggregate similar questions, and we can address them on the call. And if we don't get a chance to address all questions, we'll do our best to get back to everybody within the next 24 hours or so. But just so you know, you can download the presentation, the Horizons entire product lineup, and the product sheets for HPR and HFP, or preferred share ETFs. They're available for download in that handout pane as well on your control panel. So you can download those at any time during the presentation. Please note that this call is also recorded, so you'll be free to listen to the content at any time, and we're going to send out a replay webinar in a day or so, and it'll be available on our website. So the reason we've set this call up today, there's obviously been a lot of questions in the preferred share market, so we wanted to sort of address as many as we could at once and try to provide this as a timely update and potentially an opportunity for you to make a decision if you're interested in looking at the preferred share market at this time. So as we're going to get started with the presentation, I'll introduce Nick, and then we'll get started. So fortunate to have Nicolas Normandeau on the call with us. He's a member of the Integrated Fixed Income team and the portfolio manager at Fiera Capital. The Integrated Fixed Income team manages about $27 billion in assets, and Fiera as a total runs about $140 billion. So definitely great on the institutional management side, and doing an excellent job for us at Horizons. So we're fortunate to have Nick on the call with us. He has over 15 years of industry experience and has been with Fiera or predecessors since 2009. He's a master's of finance and also a CFA. So Nick, thank you for joining us. Obviously, sort of the big question today is, can you speak to sort of what's happened in the Canadian preferred share market in the last sort of 6 to 8 weeks, and why have they sold off a little bit more relative to equities in that time period?
All right, thank you, Jeff, and good morning, everyone. So the pref market is having some difficult time. In fact, the market is getting crushed as we speak. On a year-to-date basis, the overall market is down 6.7%. This is as of yesterday in total return. The rate resets are slightly underperforming so far this year. They're down about 6.8%, and I would say all of the underperformance happened in the fourth quarter. Just since the beginning of the quarter, the universe is down almost 8.8%, while the resets are down 9.3% in the fourth quarter so far. So really a big sell-off, I could say, and really everything happened in October 4th, which was not a long time ago, that when the market was up around 3% at that time. So almost 10% on the performance since. Which is a really important sell-off. So all started with the global liquidity sell-off, I would say. But when we look at numbers as of today, the TSX 60 in Canada is down 6.7%. Well, in fact, 5.4% year to date. So the preferred are again underperforming the equity market, a little bit like in 2015. And the S&P 500 is still up year to date, but it's getting crushed also in the fourth quarter, but not as much as the Canadian preferred share market. So when we kind of dig further, we kind of say, oh yeah, credit is repricing a little bit right now as we speak. The investment grade corporate bonds are year to date wider by 20 basis points, almost all of the 20 basis point widening happened in this quarter, in the fourth quarter. But it's not as bad as 2015 when the spreads from the tights, let's say, of the summer of 2015 to the wides of early 2016, the spread kind of widened by 65 basis points. So we are at 20 basis points so far, so totally not as bad. And when you look at the U.S. credits, yeah, also there's a repricing right now as we speak on the investment-grade corporate bonds. They're wider by about 40 basis points on a year-to-date basis. But again, when I come back and look at 2015, 2016 widening that we saw, well, it was 80 basis points at that time. So it's about half right now what we're seeing. High yield, so far this year, we're wider by, in the U.S., wider by 70 basis points in fact, just this quarter, it's 100 basis point wider for high yield. So it's an underperformance, but not as much as close to 2015 level when spreads widened by 300 basis points. So yes, credit is underperforming a little bit, but not that much, right? So when we look at interest rates, that's interesting because the 5-year rate, when I look at it as we speak, it's at 227 right now. So really, really, really much higher versus the level we reached in 2015. When oil was so low, when the 5-year rate was around 0.5% at some point. So no, it's not because rates are decreasing that the preferred share market is having a difficult time. So what is it, right? It's flows. Right. Like in 2015, when I would say back in that time, it was mainly retail investors selling individual lines because the advisors or investors were kind of scared with the market. Now, what's different is, yes, there are sellers, but it's mainly ETF selling. But it's not really big size. And when you look at it, let's say, ZPR, the BMO ETF, passively managed, since October 31st, these guys got outflows of around 70 million. So it's not that much, right? You look at CPD, also passively managed. These guys also got an outflow since the early October of around $20 million, right? So when you combine all the passively managed ETF, like since October, is about 100 million outflows. So it's not big size, right? On the active ETFs, I would say, generally speaking, since early October, it's about flat, right? Let's say we just look at HPR. Some days we're receiving in flow, some days outflow. So it's about flat, maybe slightly net negative flows, but it's really, really, really small. So what's the problem? Yeah. The problem, I would say, is that the way some investors are trading the ETFs, that's really where the problem is coming from. Because the way you do this, let's say you call your ETF desk, you ask for a bid, these guys give you a bid. After that, when these ETF market makers are kind of long the preferred share asset class, these guys, they don't want to stay long, right? They want to edge themselves. So what do? They turn and sell all the individual securities in the in the ETFs, right? So these mark-to-market guys, ETF mark-to-market guys, they don't really care about, let's try to find a role B buyer. Oh no, there's a role C buyer, so let's call this guy. They don't care. They just sell all the lines, send all goes, and it's trading, let's say, 100 shares at a time, and you kind of see big move. Just yesterday, for example, at some point, someone sold ZPR, 300,000 shares, which is about 3 million. It's not big, right? And the market moved from about flat to minus 0.5%. So really, really tough on the liquidity side. And it's really even small size trades that is doing a lot of damage right now. So the problem is that right now, there's no buyer. Looks like everyone is waiting to see some stabilization into the equity market, which we're kind of not seeing really so far, or stabilization into the credit market. So really the problem right now is the buyers have kind of disappeared, and it looks like some of the ETFs, and it's not just ETF, also we're seeing some outflows too in some funds, right? So it looks like the sellers are kind of taking profit. Maybe it made sense at the beginning, but right now when the market is down almost 10% from the peak, if you sell right now, it's because you think there is a recession coming. So we're going to talk about this a bit later, but after that, we've done some work. So, okay, is it the structures notes, right? Remember, they've done a lot of structures notes at BMO, at TD and National on the ZPR, But that was a 2016 story, and I would say most of them have been redeemed since, 2017. So as we speak, as of today, there's not much structures notes on ZPR and even on HPR in the market outstanding. So that's not them, right? So some say, okay, is it the tax loss selling? Remember, like in 2015, everything was kind of exacerbated with all the tax loss selling. And as we speak right now, we are kind of in this period. And of course, there's more candidates now that you could do this tax loss selling, as most of the preferred shares are down. So yeah, maybe a little bit of that right now, but I am not so sure that it's totally because of the tax loss selling that we're seeing this sell-off. So when after that we look, okay, what's doing okay and what is getting crushed? Well, first, I think everything is down, right? So nothing is really outperforming, but all the rate resets that have a big reset, so 400 plus, are doing way better in this sell-off, right? So like banks with high resets, like Royal R, year to date, quarter to date, sorry, they're down 1.1%. So it's not good, but it's way better than the overall market. So, but whatever has a mid reset or low reset level, these guys are getting crushed big time, right? Can give you some example. Whatever banks with a low reset, it's down 10% quarter to date. Like if you look at some energy name like Pipeline, like TransCanada, some of them are down 18% since the beginning of the quarter. You look at Enbridge, down 10%. You look at Brookfield Renewable Power, almost down 20%. That's a lot, right? And of course, AltaGas, which is what's all going on, this one is down almost 27% since the beginning of the quarter. Even fixed rate perpetual are not really performing well, right? Not as bad as some of these lower reset level, but they're down in average around 7.5% since the beginning of the quarter. So where are we now with this sell-off, right? When I look at, let's say, a total return index, when I look at the index, right, from the level right now, we're back to mid-June 2017, right? At that time, the 5-year rate Canada was at 106%. Like I said, we're at 227%, and even the Bank of Canada overnight rate is at 175. So we're really, really, really much higher than what we used to be. If we just look at the price return, yeah.
Nick, were we as high as 2.5 at one point on the 5-year Canada?
Yeah, but we're still close to these levels. We're at around 230, right? 227, if you want to be precise.
Right, so off a little bit, but nothing close to 2015 levels, of course.
That's what I was saying. And right, if we look at the price return index, we're back to December 2016 level. And at that time, the 5-year rate was also around the 110 level. So really, I think that right now the market is really oversold. If you look at right now on HPR, what's the dividend yield right now? We're at 5%, the actual dividend yield, right? So if you put a tax advantage out of it, it's around 650. So it's really getting really attractive. And we've done some sensitivity analysis on this dividend yield going forward, right? And if we look at if 5-year rates stay where they are right now in a year, and we do another conference call like we're doing right now, the dividend yield of HPR will move up by around 20 basis points in 2019. And you should expect another 20 basis points of increase to go to around 540 in late 2020 if the 5-year rates stay at the same level. And if, let's say, no, you're a bit more pessimistic about the economy and all this, and say, no, 5-year rate is going to 175, well, guess what? The dividend yield on HPR, even next year, will stay also around 5%, right? So no really move. And will also increase at 5.15. So a 15 basis point increase, even if the 5-year rate moved down by 50 beep from the level right now. So what should we do, right? Well, if you think there's a recession coming in 2019, I would say it's still time to get out, right? It's still time to go. But that's really not what we think will happen in 2019. So as we don't think there's a recession, we won't see a recession in 2019 and 2020, we think that you guys should keep your exposure to the preferred share market and even consider maybe adding to the asset class, right? we all know that growth in Canada and also US won't be as big as what we're seeing in 2018. Everyone is talking about that the global economy, well, we have reached the global growth in terms, we have kind of peaked the global growth, and all same thing for earnings, that we have reached the peak. I get it, right? But it's not because the growth in the US won't be 3% next year, as it is right now, but it will probably be around 2% or even higher. So it's still above potential and still totally not in a recession-like environment. And we can say the same for Canada. This year we're probably around like the mid to high twos, but next year what we are forecasting is to have a growth around potential and around 2%. So which is still really, really strong. And when we kind of stop and just looking at the fundamentals, if you start with the U.S., it's still doing extremely well in the U.S., right? I know growth won't be as big, but like I said, but unemployment is still around 3.7%. I've seen no numbers that kind of shows that this is about to turn yet, but we'll get the employment numbers soon, next month. When we look at claims, it's still really, really strong. Inflation is still around 2%. There's no deflation risk or whatsoever going on. And when you look at Canada, I would say the same thing. It's still like full unemployment around 5.8%. So it's still doing extremely well. So some people can say, yeah, but oil is getting crushed this day, also the WCS discount also has widened a lot, and this I think it's important to monitor. Of course, for us, we think that despite the lower oil environment, that the Bank of Canada will probably continue to hike. And probably even next January to go to the 2%. But of course, if oil stay low and if the differential, if the discounts remain as big for the Canadian oil price, we think that it will be difficult for the Bank of Canada to kind of go to their neutral range of the overnight rate. What's their neutral range? It's between 250 and 350. So if oil stay that low, we think it will be really tough next year to reach the 250. And maybe it will end up around 2 or 2.25, right? But that's good news for credit, to maybe have the Bank of Canada to be more on the sideline, right? And it's not because the Canadian oil prices are on 18 that the Bank of Canada is about to cut, right? What we think is that they might pause sooner. So that's important. And on the Fed level, on the U.S. level, lower oil is a positive. It's a positive for consumers, of course. But on their side too, we think that they're going to hike again in December, the month that is coming, and to 2.5%, and that at some point, maybe around June next year, they'll reach 3%, and that will be it, right? So we think that this will be a positive. Maybe even over the next meetings, both the Fed and the Bank of Canada will start being a little bit more dovish than what we kind of saw lately. So that could be perceived really, really positive for the market and the market tone and the equity tone, right? So some people are asking me, hey Nick, should we wait to see some stabilization in the equity market before heading to the pref market, or should we wait until the tax loss selling is done before we buy preferred? It's all kind of, yeah, you could. But that's kind of being cute, right? The market is down, has decreased 10%. So what I like to remember to investors is that remember 2015, right? There was again not much liquidity, right? On both sides, on the sell and buy side, and at some point late in the year, like December 14th to be precise, there were big buyers of preferred shares, like 50 million order into one of the passively managed ETFs. And you guys remember what happened to the pref market asset class? It increased, it spiked rebound by about 12% from December 15th to December 31st. So I'm not suggesting we're going to see that type of rebound, right? What I'm just saying is that you don't need much buyers of preferred to see a big reversal, right? And we're start seeing more and more interest from institution buyers now that the market has kind of decreased, and at some point maybe one guy or two guys will come back and put big orders, and you could see some 3, 4, 5% reversal really, really, really fast. So that's one thing. We can also talk about the new issue market. I think that's also important to discuss this, right? For 2019 or even for the balance of the year, right? We think that banks will continue to be really active on the new issue in the Canadian preferred share market for the next 6 to 9 months, just because they have redemptions, right? Just TD 2 days ago announced redemptions of their old Tier 1 that they print during the crisis, right? But that's $1 billion, right? Redemption that they're doing. In 2019, there's other old non-NVCC issues on the pref side and also on the hybrid side that will get redeemed. So when you combine all these from now to June of next year, we should expect around $5 billion of redemption. So I'm not saying here that they're going to have to print $5 billion. No, but they will maybe print half of them or try to print half of them. And so that's why we think that the banks will continue to be one of the most active guys on the preferred share market class. But what I think that right now is that it's not going to be that easy now, as we speak, for a bank to print in the Canadian preferred share market. I don't think we're back to the 2015 wide levels, but the last issues that we saw with a 4.8 coupon with a 238 reset, well, that's too bad for the banks, but it's not going to be possible for them to print at these tight level anymore, right? And when I look at the market right now, the secondary market level, I think that if the issuers, if that's a big if, because sometimes, well, these guys are a little bit greedy, right? But let's say if they want to be just fair with us investors, the bank should print at 5.5%, which is a reset of around 320 basis points. That's the level. If you guys want to kind of buy back some new issuance, wait for that. If they come at 5%, the next issue, which will be better than the last RBC issue that they print, but guess what? This one is trading about $2 discount now, right? At 5%, you guys should pass, right? This is going to be too pricey, and the secondary market is way cheaper.
Right, Nick, and that was one of the questions. So you expect some of these new issuances to increase their coupons a little bit, and will that affect the secondary market of the existing ones?
Well, when you look at the secondary market right now, and like most of the rates reset that trade at discount for banks, let's say the reset of 220 up until 290 or whatsoever, all of them are trading now at big discount, right? And the expected yield, assuming the 5-year rates remain as is, it's a mix, but it's around, it's moved from, let's say, 560 to 570, 575. So you kind of have some protection versus a new issuance. But like I said, I think 550 is a fair level, but the banks won't print there, right? They're not as desperate as that. So they'll try a 5% before going to 550. So that's why I think the secondary market has a lot of protection right now from the potential new issuance. But maybe at some point, as the market is not super strong right now, maybe at some point the banks will be forced to print around a 550 level. But really, what's important for us as investors is to kind of get at least a 300 reset. And frankly, if you look at some issuance, like if the ones that we like right now, it's not the deepest reset, like the lowest reset level. It's really like on the mid reset. That's what we've been buying for over the last year, right? And most of them it's hard also, right, over the last 2 months. And what we like is the one that will reset over the next year or the next 2 years, right? In 2019, 2020, that trade at big discount now. And that's with the 5-year rate right now as we speak, the next yield will be around, like it says, 550 to 570 for some, to 580 even for some life insurance. You're at 6% for some of them. For some pipes you're at 7%. So that's the sweet spot for us that we like right now. It's really the one that will reset over the next 2 years that trade at discount. That's how we are kind of positioned. HBR right now, and also same thing for HFP.
Okay. Nick, so with that, the recent decline, are you using this as an opportunity to reposition the portfolio within HPR or HFP to any extent?
Of course, there's lots of volatility, right, and some big shift for some issues versus others. So right now, what we like to do is to kind of do a little bit more crosses, not crosses, but switches. So sell one that has kind of did a little bit better for another one that has got crushed more, stuff like that. So we're kind of a little bit more active. It's difficult to find big flows, right? And there's not much big sellers, like I said, right? So all the sales was not all, but most of the sell has been exacerbated by the ETF market maker, right? But they're not trading size, right? It's 100 at a time. So that's why I said that the moment like buyers come back, and they will at some point, right? As I don't think there's a recession coming for next year, then we're not going to need that much big buys to kind of put an upside on this market. So for us, it's tough to find flows. We're still kind of had slowly to some lines that we really like at really, really great levels. But we're not really trading like a lot because there's not much sellers right now, right? And we're for sure not selling for now.
Okay. Are there any segments of the market that you're avoiding at this point?
Names that we avoid, no, but I don't think it's time to buy the high resets, right? Like the banks with 400 resets, if let's say you live in the corporate bond world, I get it, right? You can buy them. You have a nice pickup of yield versus corporate bonds. But if you want to kind of participate to the rally of the preferred share market, if at some point there is one, you need to focus more on the mid resets, right? The one that trade at discount. So it's not. I'm not avoiding them because of a credit problem. It's just avoiding them because I think they're expensive right now, and that I think there is much more upside with the one that trade at discount. So that has been the trade for HPR, and we're keeping that trade, and we're even adding to that trade for some that are getting really, really crushed, right? For the issues that are really getting it the most. So. But credit-wise, I don't see. Well, you guys know that we're not big fans of the weaker names like Norton Power, TransAlta, Capital Power, AltaGas. It's a name that we think will see a downgrade, but will remain investment grade at S&P on the debt side at BBB minus. The preferred will move from P3 high to P3 mid by S&P. So. It's okay, and I know they're doing a lot of changes. They're changing the CEO. I get it, right? They have still some funding to do, but most of the funding for the acquisition is done. And at the end of the day, this company will be now mainly a U.S. utility company that 80% of the EBITDA is coming from regulated assets, which will be just great. And this company has been showing in the past that they want to remain investment grade, and we are believing them. And now they will sell probably a little bit more assets to kind of reduce that. So that's maybe the only name that we can really got a bit weaker, maybe for more credit reasons. But everything else, like banks, life insurance, even Enbridge is improving, right? They were seeing some increase in their rating. They're decreasing that, right? They're doing a lot of great things, right? And the repricing that we're seeing is way more than what really it's going on the credit side. It's really more just because people are selling the market, and Enbridge, there's a lot out there, right? Same for BCE. BCE is getting crushed big time, but there's no problem with the BCE credit. So that's why, right? As long as you don't think there's a recession coming, this is a class is cheap right now. And like I said, dividend yield is getting higher and higher and will continue to increase. 70% of what we are buying in HPR is trading below $24, right? Not a long time ago, it was 50%. It's not because we have increased that, right? We've increased a little bit, but not much, right? It's really because the market has decreased in price. And the preferred share market is a small market, around 70 billion now. It used to be 80, but with the sell-off, it's now more around the 70 billion, and it will always be less liquid than whatever other market, right? So you will always see more spike of volatility with preferred. And I think that for an investor, as long as you think you're getting paid for that illiquidity, which right now I really think we are with this 10% sell-off, as long as you're okay with that and that you understand that on the midterm horizon, you should expect around the coupon, which is around 5% right now. So let's say between 4.55%. But that you understand that you'll see some volatility spike and you're okay with it. This is still a really good asset class to be in, right? And right now, the entry point is, I think, interesting as long as there's no recession, of course.
Okay, good to know. So based on your interest rate forecast, you think longer term the discounted rate resets should outperform the corporate credit and the perpetuals?
Yeah, there is more upside on the rate reset, and it's not just on hope that we see higher rates, right? Not at all. Even if the 5-year rate go to 1.75 or 2%, it's okay, right? Right now, with the sell-off that we saw. So of course, it's as long as the 5-year rate don't go like at 1% or 0.5 like in 2015, but that's not what we're seeing, right? We're thinking that the bank will slowly continue to hike, might pause sooner than maybe what the bank was themselves anticipating 2-3 months ago, but they're not about to cut, right? And I think that it's like we're seeing right now, it's not preferred shares, like I'm kind of saying to a lot of clients, it's not just an interest rate story. I know that in 2015, 16, 17, and almost all the year in 2018, rates were the main driver, but it's also a credit story, right? We're buying perpetual. We're stuck with these credits forever, right? So we need a stable credit environment. And we're seeing some widening on spreads like I was saying at the beginning, but it's not that much, right? And we think that we're okay with the credit spreads environment. Yeah, we could see some small widening over the next year, but nothing important, nothing really big, right? And even on our corporate bonds portfolio, we're starting to kind of look at names to add and all this that has kind of repriced also. So because we kind of prefer the spreads now than a month ago. So for most of the names, and if there's no recession and that growth is just like closer to potential than the last 2 years, it's just okay for credit, right? And if at the same time you see both the Fed and the bank to be more patient, that's even better, right? That means that this cycle will last maybe longer than if they continue to hike towards 3%, if not more, right? That for the Bank of Canada or even the Fed. So that's perfect environment for credit, I think.
Excellent. So again, based on your assumption that if we don't have a recession, definitely you see a buying opportunity around these levels in the preferred share space.
I agree. Yeah, but right. I think the opportunity is right now, unless you think the recession it's going to happen next year. But don't wait a year to find out if there was a recession. It will be too late.
Right. And sort of in the midst of tax loss selling, you've addressed this a little bit. There is some tax loss selling. Just sort of could that be continued pressure? And the reason I bring this up is, I remember in 2015 and 16, a lot of people were using our ETFs as an opportunity to they can trade in kind their individuals, the preferreds, into a more diversified basket of our ETFs and capitalize that loss, and then have a more diversified basket in HPR or HFP. Do you think sort of that timing is around now, or do you foresee a little bit more pressure during tax loss season?
We're in this right now as you speak, right? So we're gonna get more of that from now to, let's say, around slightly before Christmas, and this will probably, usually in the past, it's kind of put a little bit of downside pressure, but that's one thing, right? And we're kind of already seeing some clients selling out some lines or other ETFs in exchange of HPR to take advantage of that. So that's kind of the start, but I think it's just the start of that thing, right? And we kind of see more in this early December. But like I said, if the global liquidity tone kind of reverse, if the market stabilize on the equity side, and if credit start to catch a bit for corporates and and high yield, if oil stabilizes from the level right now, if the discount kind of shrink from the minus 30 something dollar to, let's say, minus 25 versus WTI, I think this could be a much bigger driver on the upside than the stacks off thing, right? And again, the market got crushed on no liquidity, no volume, and you don't need that much buyer to kind of reverse this. I would say, yes, you can kind of be cute and wait until Christmas to buy, but you might lose like a 3 or 4% rally if things improve on the credit side and well, just on the tone side, right? So that's why I think.
Go ahead.
It's okay.
I just wanted to remind our attendees that we do offer an in-kind exchange program for any individual preferred securities. You can trade that on an in-kind basis with our ETFs, and if you have questions on that, make sure to reach out to info@Horizons or your specific territory sales team. So I think we've addressed quite a few, some more of the general questions on sort of liquidity, the credit spreads or credit concerns, and the tax loss. And you also mentioned some institutional investors are sort of looking at this as a buying opportunity. And I believe even the tactical asset team at Fiera has mentioned they're looking at this as a buying opportunity. Are you seeing that in the institutional markets?
Yeah, more and more. Some friends on the institution side, more and more people are looking at this asset class. It's just the move that we saw in the pref. It's minus 10%. I repeat, but that's a big move, right? While on the credit side, it's 20 basis point wider year to date, right? So it's not a big move for the credit market. So and the pref market is again underperforming the equity market, which makes no sense here, I think. So yes, we will see. I think we will see more interest from these institutional buyers. And will it be with mainly new issue at start? Maybe. And let's also not forget the hedge funds guys, right? These guys were really there, and then from US, from Canada in late 15, early 16. And are they kind of looking at the market right now? I don't really know. They don't tell me, right? But I think at some point these guys will come back and take advantage of the sell-off, if of course they're positive on the economy, right?
Good. Okay. Thank you. So as I said, I think we've covered a lot of the general stuff. So maybe we'll just spend a little bit of time getting into some more specific questions from our attendees. And one attendee asked more about a name specific and in Brookfield specifically. So some of our attendees were surprised that Brookfield is down as much as an AltaGas. Any comment on those specific names? I know you've mentioned AltaGas a bit, but are you looking at Brookfield at this price?
Within Brookfield, there's many different entities that you can buy, right? The one that are getting crushed the most is the BRF, the Brookfield Renewable Power. These issuance are really cheap right now, right? And like I said, that some of them are down 20% since the beginning of the quarter, right? I know there's leverage at Brookfield. I know there's a nice and juicy dividend yield on the equity side, but now the preferred are getting really cheap, I think. As for BAM, I think BAM is always more expensive than the other Brookfield entities because it's better rated, like a P2. You got the diversification because you have the BAM level, so you're getting the exposure from the real estate, from the power, from the infrastructure. But I still think BAM right now as an issuer is slightly pricey when you look versus BRF, the Brookfield Renewable Power entity, right? After that, if you look at some BIP, I would say depending which one you're looking at, but the BIPA I think is really attractive still, but nothing as cheap as the BRF entity right now on the rate reset side, and even on the perpetual side. We haven't really discussed the perpetual, right? But we've been adding some here and there in HPR. When I can buy and I have access to a Great West perpetual around 6% at the point it was $5.95. When you put a tax advantage out of this, $5.95, you're like at almost 7.7%, right? That's really nice yield for a name like that, for a great credit like that. So I'm not suggesting that that's just what we've been buying, but names that we like the credit that has repriced and that offers really attractive yield. Yes, we will go and buy like in HPR. But like I said earlier, I think the opportunity is more on the rate reset side and the one that traded discount. So to go back to Brookfield, you should expect also, I was talking about banks will probably be active in the new issue level, in the new issue market, but you should also expect BAM to be active. BAM is buying, is doing some merging and acquisition. Same for BRF, same for BIP. These guys are even at BPO level. So you should expect them to continue to be active in the preferred share market. But some of them are getting attractive. BPO is the real estate part also is getting crushed, but leverage at this entity is really high. And if I have to pick one Brookfield entity, it will be Brookfield Renewable Power, and not the other ones.
Okay, excellent advice. Thank you. We had up the performance slide a little while ago, and we're putting that back up now for our viewers. HPR and HFP have definitely been leaders in this space and have significantly outperformed the benchmarks in most mandates over 3 and 5 years. But someone asked us more specifically about the year-to-date number and noted some underperformance to the benchmark on a year-to-date of about 1.5%, and asked for some of your comments on why that might be. Was it more on the rate resets recently?
Yeah, we have a little bit more of the one that traded discounts. Like I said, we're around 70% exposed to these issuance. And while in the universe there's less than that, it's not even 60%. So of course, this overweight position that kind of helped us in 2016, in 2017, and up until October of this year, right? It was really great positioning. But since then, with the sell-off, like I said, it's mainly the one that traded discount that has been suffering the most. So we have a little bit bigger exposure to these ones. So that's why HPR and HFP is underperforming. As we speak, I'm not sure about the levels you mentioned, but maybe that's after, maybe that's like the HPR price and after fees. But before, I know sometimes we're living in that before fees on our side, but HPR is probably down around 80 basis points versus the universe since the beginning of the year. So not 150. So even if you add the fee, or not as much as that. So maybe there's a little bit of discount to have on the performance that you're mentioning. But we're confident that we will kind of reverse this, right? It happened really fast because at some point HPR was up 80 basis points. That was somewhere in September, right? So we're confident with the position that we have. It's no credit issues with the issues that we are maintaining. It's more like a repricing. And like I said earlier, the 5-year rate is still close to the peak. We're not at 250, where we're close to the peak. And most of them will reset with a 5-year rate close to the peak. So that's why we like our positioning. And when we compare all of these discounted resets versus the one that has floor or the ones that have big reset that are still trading around par or even higher than par, well, we think the upside for the one like with high resets is really limited from now, right? While on the ones that we own the most, the upside could be really important for some of them. So that's why we're kind of keeping that positioning. And like I said, we're even increasing to some that we think it's getting too crazy, the levels they're trading.
Great. And what is that percentage of rate resets in the portfolio right now, approximately?
We're around 78% of resets. But you need also to add like the floating round preferred, because we have like around 7% exposure to floating preferred. So when you combine both of them, we're around 85%. Some of the floating will have the option in a year or 2 or 3, depending, to go back to the fixed side, right? To the fixed side on the rate reset. So that's really what we have. When you look at just perpetual, we're around like the real perpetual in HPR, we're around 11% right now. And like I said, we've been increasing a little bit that at really great levels for some names that we like Great West and Sun Life and even some Manulife at some point. But really the biggest overweight is on the rate reset side. And on the folding side, it's not on hope the bank will continue to hike. Even if the bank stop hiking, most of them, if not all of them, are well priced right now. And like I said, we'll have the option at the next reset to go back, fix if we want, or stay afloat as we wish at that time. So that's the positioning right now.
Thank you, Nick. Yeah, and in regards to the performance slide, everything we do show is net of fees and expenses, and we have that too as of up to last Friday, November the 23rd. And again, I think historically and over longer periods of time, you've added significant value over index and over competitors, and year to date, most of that slight underperformance has come in the last sort of probably 6 weeks or so. And as it reverts, we're hoping to see that catch back up and above benchmarks.
And also, Jeff, to add, we could say that the passively managed ETFs right now are, for this year, which has been a while, right? It's probably the first year since these guys have been out there, their first quartile this year, right? Every active manager is not every, but most of them are getting a little bit of tough time, right? And that's why I think that right now, if some of you own some CPD on ZPR, as these guys still love the high resets, right? They love them. That maybe they think, well, that the market will continue to go weaker. Maybe the opportunity to sell these that have outperformed over the last 2 months to buy HPR or HFP that has been a bit underperforming makes full sense right now. Timing for that could be also great with the tax loss and all this. Plus, you kind of go and buy an ETF that has a little bit more torque if things stabilize from now.
Okay. Good point. One other question we've had sort of throughout is more a Horizons question. People are asking if we're expecting possible year-end additional distribution. And right now, at this point, we do not expect any additional year-end distribution, just the regular distribution that come out on a monthly basis for HPR and HFP. But Nick, maybe just time for sort of one more general question, more broad in the fixed income markets and on interest rates. So can you sort of comment on rates? I know you touched on it a little bit, but sort of what Fiera's view are on rates, and the yield curve right now is quite flat. Do you see that continuing, and what does that tell us about the markets in general and preferreds?
Yeah, we think that as the bank will probably continue to hike slowly, maybe another shot, maybe two, that at some point, maybe around mid next year, and the curve will be even flatter than what it is right now. So that's an important indicator. Usually, what happened in the past is when the curve became really flat, at some point, there's a recession coming over the next 12, 18 months, depending the year, right? So that's an important indicator. But also, that's another reason why we think both the Fed and the Bank of Canada, it will be tough for them to hike too much from now, right? And from what it is expected right now in the market also. So these guys, they don't want to have a flat curve, right? They know what's going on after that. So both the Fed and the Bank of Canada, their goal is to make sure that this cycle ends forever, right? So they're gonna do what's necessary to make sure that this cycle continue. So that's like I said, another reason why we don't think they're gonna hike much from now. We're close to the peak right now, so maybe another, like I said, one or two, and that's it for Canada.
Okay, excellent. Thank you, Nick. I think throughout the presentation we were able to answer most of the questions one way or another. But if there are continued questions from many of our attendees, please give us a call. On the webinar screen right now, we have our 1866 number, our email at info@horizons.com. And we're also quite active socially on LinkedIn, Facebook, and Twitter. So please follow us there. And Nick, I think you did a great job sort of giving us a complete update and overview on the preferred share market, explaining sort of what has happened in the last 6 weeks, and definitely positioning that as an opportunity at these prices, especially if you don't see a recession in the near future. So again, I want to thank everyone for attending today's update and Q&A session on the Canadian preferred share market. And if you do have any other questions, again, please contact us at our 1-866 number or info@Horizons. Once you leave today's webinar, you'll receive a survey on the presentation. We'd appreciate it if you'd complete that and provide us any feedback, because we're always looking to get better and continue to serve our loyal investors. And you'll also receive a follow-up email within the next 24 to 48 hours with a replay recording of today's webinar if you weren't able to attend at all. And for those that weren't able to attend, we're going to send out that webinar. So Nick, again, on behalf of Horizons ETF and our presenter, Nick, we want to thank everyone for joining us today and have a great rest of your day. Thank you.
Thank you. Bye-bye.